A new report from RBC warns that mortgage delinquencies could rise by more than a third over the next year. And joining us now to discuss this is David McDonald, senior economist at the Canadian Centre for Policy Alternatives. David, thanks so much for joining us. I'm just going to recap this report forecasting mortgage delinquencies to rise by a third over the coming year, while consumer insolvencies could increase by nearly 30% over the next 3 years. Explain for us what that all means.
Sure. So these rates, either on the consumer side, consumer delinquencies, these things like car loans or credit cards, fell substantially during the pandemic. And mortgage delinquencies have also actually been falling for a long period of time. During the pandemic, there was a lot less to spend money on, and so people paid down debts. That is running in reverse now. And so we aren't quite actually at the delinquency levels that we saw before the pandemic. But with these increases or projected increases of about a third, we'd be roughly in the neighborhood of the delinquencies in 2019 prior to the pandemic. To put this in perspective on the mortgages front, right now, 99.85% of mortgages are up to date, not in delinquency, and that might fall to 99.8 after this increase. So, in context, it's not a dramatic change as a percentage term. It is big, but this would kind of just get us back to where we were before the pandemic.
David, who will be most impacted by this?
Well, when it comes to mortgage delinquencies, you're more likely to result in bankruptcy if the value of your house has dropped, and so potentially you lose your job. Or you're paying more in interest payments. So certainly a lot of Canadians are paying more in interest payments. Not a lot of Canadians are losing work at this point. The labor market is strong and wages are rising. And so that piece of it has yet to come into play. If we were to see a recession at the end of this year, the start of 2024, that would likely mean an increase in the unemployment rate, which would mean potentially that people lose their jobs while they're facing higher interest rates. The other piece of the puzzle, though, is that in order for delinquencies to turn into bankruptcies, you must have a declining value in your house. If you can just sell your house to cover the mortgage, then you're not necessarily going to get that caught. And so, if we compare house prices today to where they stood in 2019, they're well above where they stood in 2019, despite the fact that we have seen a decrease since March or about this time last year. So the mortgage delinquency piece is going to be for people who bought a house, in 2020, 2021, were very stretched to get there and happened to lose their job maybe in the next year. Those are the folks who are going to be most at risk. When it comes to consumer delinquencies, these are credit card loans or car loans. This might hit folks a lot harder because they wouldn't have an asset to fall back on. They wouldn't have a house to sell, for instance, to cover their credit card debt or their car loan debt. And so these are folks that, again, if you lost your job with these higher interest rates, then you might be in a real bind. And so that might be people that don't have other assets to fall back on, and that might be broader. Those are also likely to be folks that may not be as wealthy in the first place. And so that, in my mind, is slightly more concerning than the mortgage delinquencies going up.
Okay. David, thank you so much for weighing in on this for us. David McDonald, senior economist at the Canadian Centre for Policy Alternatives. Thank you.